Hello everyone, and welcome to another episode of Investor Insight. I'm Joy, Financial Advisory Director at Financial Alliance. And join me today is my co-host Marcus, Investor Consultant at iFAST. And we are also very excited to have a special guest in the studio, Raphael Lim, Associate Director of Research and FinLit at SGX. Today, we are diving into the world of REITs, a sector that has been a long-time favorite in income-focused investor. But with the interest rate at multi-year highs, market conditions have shifted, and so have investor strategy. In this episode, we will take a closer look at where the REIT market stands today and what's driving these changes and where the opportunity and the risk may lie, and also answer the common question that my clients always ask as well. So let's start with the big picture. So Raphael, looking ahead, may I know what's the REIT outlook for over the next 6 to 12 months?
Yeah, so it's a very interesting question, and I think you also alluded to it, some of the macro conditions in your introduction on how interest rates are affecting the sector. So maybe I will break down this question into really some of the upside drivers and maybe some of the downside risks for the sector that we can think about. So naturally, interest rates are a big one for the sector. How it will trend. I think people know that since 2022, interest rates in the US has been trending up to fight inflation in the US, right? And that has been something that people have been monitoring because it has a direct and indirect impact on REITs. But having said that, I think interest rates are important because now we are at a kind of an inflection point and we are thinking a little bit about how the interest rate direction will look. So I think last year, in Q3 last year, we saw the Fed cut interest rates for the first time. In 2025 so far, we haven't seen the Fed really cut that much of its interest rates. But in the Singapore market, if we look at 3 months SORA, I think start of the year it was above 3%, and now I think it's about 1.75%. So it's fallen quite a bit for the sector. So naturally, interest rates is important to look at because as it goes down, for REITs, the direct impact, their financing costs, it will go down and it will help a little bit with their distributable income. And then on an indirect basis as well, the relative attraction of REITs, back maybe like you dial back 1 or 2 years, we saw like T-bills, SSBs, they were yielding 3-4% for risk-free assets. So that's a bit of a competitive situation with REITs. And then on average, our REITs still trade about 6 to 7%. So for an income-focused investor who doesn't mind a bit of risk, this is something compelling to think about. Having said that, we are still waiting for significant re-rating in the sector. I think we have seen the IHS REIT index. It's hovering around the 1030 to 1040, 1050 levels. Even though the interest rates in Singapore have come down, the sector hasn't re-rated that strongly yet. Some analysts have said that possibly people are just waiting to see what the Fed does, and when it finally cuts, then maybe more investors would be interested. Clearly, interest rates is something to watch for as a potential catalyst in the coming months. But even when we talk about potential catalysts and upside, if we look at how the sector has performed in the year to date, I think the IHS REIT index as of yesterday, year to date, total return is about 8.7%, including dividends. I think that's a pretty decent return for investors. Out of the 30 constituents, 25 have positive total returns for the year to date. So it's ready to see whether this can continue to have legs downstream. But you also want to be mindful on some of the potential risks. One of the things I can think about is foreign currency translations. Sing dollar has been actually performing quite strongly this year, right? I think like start of the year, Sing dollar against US dollar was about 1.36, now it's about 1.28. So for some of the REITs that have overseas assets in countries where the currency is not performing as strongly, that can have a bit of a weakness in translation effect when it comes back to Singapore. But on the flip side, for some of the REITs that have assets, say in Europe, where the euro is strong and then it translates back, then actually it's positive for them. So it's a bit of a double-sided thing to consider. The other thing to also consider as well is the impact of some of the trade uncertainty, the tariff situation. I think we see markets right now, they are powering towards all-time highs, but there is still a bit of uncertainty on that front. Some of that could weigh on business sentiment, then whether it will impact leasing demand downstream. It remains to be seen. Some of the more cyclical sectors could also have some of an impact. So, some of the analysts point out that maybe more defensive segments could be like suburban retail, healthcare. These are some of the things for investors to consider. So there is a bit of cautious optimism as we look downstream. We'll see how the different factors play out.
Thanks, Raphael, for your outlook. You talked about healthcare. It's quite a specialized REIT, and we are starting to see a lot of new entrants from these specialized sectors such as data centers, healthcare, logistics. Will you see this trend continue? What's your outlook for this this trend moving forward?
So that's an interesting question. So I think maybe if we zoom out a bit and look at the entire REIT landscape on what's available of SGX, I think in the market we have about 40 actively traded S-REITs. They span across different subsectors. So we have, REITs in the industrial space, logistics. We also have office, we have retail. Then we have the more specialized ones like data centers. And people will be familiar, I think just last month we had NTT Data Center REIT list on SGX. It's the biggest data center REIT IPO in Asia. So it's something that a lot of investors are excited and interested about, because these are assets that's powering or enabling the AI boom that is going on, all these digital infrastructure players. And NTT DC REIT is not the first data center REIT that we have on the exchange. We have two other pure play data center REITs, Capital DC REIT, of course, STI Constituent, then Digital Core REIT. But beyond that, we also have CapitaLand Ascendas REIT, Mapletree Industrial Trust. These are industrial REITs, but they also hold sizable exposure to the data center subsegment. So all in, there's about like 15 billion AUM exposed to the data center sector for investors to really consider. I think what it really is, it just broadens the opportunity set for investors to think about. If I want to invest in more stable asset classes, for instance, like healthcare, where I don't think it will be as cyclical, they have an option. If you want to be exposed to some of the very exciting new sectors, the high growth areas like data centers, AI, powering everything, they have that option as well. And I think some of the market reports have also indicated that while data center, the supply is increasing, the demand is actually outpacing it. So some of these things could really give investors the option to really express their investment objective and desire. But we have a wide range of different REITs, logistics, office, and there's really something for everybody to think about and consider based on your own investment appetite. And we are happy that there's different options available.
Yes, so we talk about so many different kind of options and opportunities. So as I know, this year we have a lot of IPO coming for SGX. It's a very good news and exciting news. So may I know, is there any kind of upcoming REITs IPO, any kind of REITs listing?
Yeah, so that's an interesting one. So I think just last week when we had our results, some of our management did allude to quite a healthy IPO pipeline in the works. And we're looking forward to that. Specifically for REITs, I think some of the potential entrants, some of them, they've already publicly announced their plans for a listing. So hot on the heels, NTT was in July, it was quite a big REIT. And then we also saw Centurion Corporation. It's announced that it's planning to list a Centurion accommodation REIT on the exchange as well. So it's in the works for that one. So for that one, they have announced in their company announcement that they really see the initial portfolio to have about 14 assets worth about $1.8 billion. That is something to look out for. Now, naturally at this point, you also want to caveat that a lot of IPOs depends on market conditions, various other factors for it to successfully come true. But this is one of the companies on SGX that has already announced some of its firm plans to have a REIT. And if you look at Centurion Corp, it's actually quite an interesting one because they have purpose-built workers accommodation, purpose-built student accommodation. So it's another type of asset that investors can think about. But I think from the exchange perspective, we always welcome high quality sponsors bringing quality, diversified assets to the exchange. This gives investors a different opportunity of what they can think about and invest in. And maybe just one more point to add, that beyond the primary listings, the new IPOs, we also see quite healthy secondary market fundraising from existing REITs. So they acquire new assets as well, right? Earlier this month, we saw CICT, CapitaLand Integrated Commercial Trust. They announced a $500 million placement. This was upsized later to $600 million. This was to acquire the remaining interest in Capital Spring. Then a few months back, CapitaLand Ascendas REIT also raised $500 million to acquire a data center asset and then another building as well. And then, closer to the start of the year, Fraser Centrepoint Trust also raised more than $400 million to acquire the remaining interest in North Point City. So it's not just the new REITs. I think the existing REITs are also quite active. We also see reports that as the interest rate environment ease, different investors, including REITs, are a little bit more open to exploring different acquisitions. And we hope this sort of exciting new developments could come and benefit the investors in the market.
I know in terms of REITs investing, have you noticed any shifting in investors' behavior?
So over in the exchange, what we look at is also the different types of investors, the institutional investors, the retail investors, how they allocate their capital and whether they are net buying or net selling different asset classes. So I think over the last few years, we have noticed that retail investors tend to be net buyers in REITs, and the trend has also continued in 2025. I think for the year to end July, retail investors have net inflows of more than 400 million into S-REITs already. Yeah, it's pretty huge. And it builds on a trend we've seen in previous years as well. On the flip side, institutional investors, they are currently net sellers of S-REITs in the market. But I think there's something to think about when we look at investor behavior is we see our retail investors, they tend to be a bit more opportunistic. They like to see value when they are investing. And I think given some of the interest rate trends in the recent past, some of the REIT valuations have been quite compelling for investors to consider. If you think about the yield, like on average for the REITs that pay distributions is about 6 to 7%. Price to book ratio is about 0.8 times. Yeah, so this is below the historical level of around 1 time, right? So for retail investors, I think they are looking at some of these opportunities when they allocate into REITs. And then for institutional investors, while overall the picture is net outflows, I think we do see pockets of times where institutional investors are net buyers into REITs. And sometimes this coincides with changes in macro expectations and changing trends. So one example, last year in 2024, the first half of the year, Q1, Q2, Insti investors were actually net sellers of REITs. But in Q3, as the interest rate cuts in the US were coming along, they actually flipped to become net buyers of S-REITs for institutional investors. So, there is still interest coming at different points in time from the different investor groups. And if you look at it at a more broad level on the appetite for, like IPOs, placements as well. Like Entity DC REIT's IPO, I think it was more than 4 times subscribed. So it's still, and it's across a different broad pool of investors. And then even CICT, their recent placement, it was also upsized from 500 million to 600 million. And even this was pretty well covered as well. I think around 4 to 5 times covered. So there is still good investor interest and appetite for this as an asset class.
So Raphael, we talked about outlook of REITs. Potentially interest rates could be coming down. That could be positive for REITs. We also talk about some of the specialized sectors, and then we also talk about what are the pipelines of IPOs in the next 6 to 12 months. The big question for investors is, okay, now I'm interested in buying REITs. How should I go about picking REITs? Most investors think that, I just find the REITs with the highest dividend yield. I'll pick that, collect the dividends, then I should be okay. Is there any other metrics that investors should look at when they are selecting REITs?
REITs are, most people see it as an income-generating instrument, and right, in a way, it makes sense because most of the time you look at the yield and what the property can deliver. I think equally important is also to kind of study how sustainable that yield will look like downstream as well. Because if your yield is very high, but then you don't know if it can be sustained, it's not very helpful, right? So how can you look and identify whether the yield can be sustained? I think important areas to look at are the operating performance of the REIT. For instance, we can consider the occupancy. Is the occupancy very high? What sort of leases is the manager signing with tenants? Is it long dated ones? That gives you a bit more visibility, potentially stability. Then also when it comes to rental renewals, the rental reversions. So some of when the rentals are renewed, is it higher than the previous rent, or when you have a new tenant, is it higher? So some of these demand factors for the REIT are some things that, is worth looking at. Then other areas that, in terms of the operating performance, we could also consider, which geographies the REITs are located at. Some people, tend to like home-based assets. They see strength in the Singapore market. For different investment theses, you can consider different asset classes potentially to express your own
investment yield.
Correct. Yeah, so that option is available. So operating performance, clearly an important one. And then the other one is also the financial metrics. And this one, when we think about it, we'll look at how heavily geared the REITs are, their aggregate leverage ratio. In Singapore, there is a regulatory limit of about 50%. It is 50%, but and then you cannot exceed that, and then your interest coverage ratio needs to be at least 1.5 times. So these measures are there to make sure that REITs are sufficiently prudent and they can keep operating and paying their distributions downstream. And for investors, you should really look at that and consider as well where the REITs are at. I think on average in Singapore, the REITs that we have in our sector average at about 40% gearing. So it's still some distance away from the regulatory limit, but the financial health of the REIT is also important to look at. And you could also see some of the REITs, for example, Cesio REIT, Ames APAC REIT, they have relatively low gearing. This also gives them a bit more debt headroom if they want to acquire assets as well. So I think overall, the sustainability of the yield is something to look at. And then it's also important to remember that REITs, they are not like a fixed income instrument whereby you get your capital back at the end and you just care about the interest rate. The share price can fluctuate as well. So it's also important to pay attention to what your total shareholder return will look like, the yield plus the potential
depreciation.
Correct, in the REIT. So I think that's how I would view it.
Thank you for sharing about different factors to measure the REITs. So when it comes to REITs investment, may I ask what are some of the key risks to REIT investors, and also how can we manage the risk as well?
Right. So for this one, I would say it's not too different from when you assess any other stock as well, right? Because there are different factors that can affect it. Some of the top down, you can have economic conditions, interest rates, and then different, even more bottom up, there's also like tenant concentration risk, which subsector you operate in. So it's important for an investor to consider some of these different elements that could play a role in your portfolio as well. So maybe, if we think about the macro conditions, I think earlier when we mentioned about the outlook for REITs, we talk about some of the downside and then potentially some of the tariff uncertainty. For some investors, you may want to consider how defensive or how resilient the portfolio is to some of the potential macro fluctuations, if that's your view. And then there are certain subsectors that are more cyclical in nature. For example, hospitality. When travel is good, it could be really good for such REITs. And then also for longer term, the demand for office properties in Singapore, given that there's a scarce supply in CBD, we could also think of some of these various factors on how it will affect downstream demand for properties. In terms of tenant concentration also, you also want to monitor to make sure that, if a REIT has quite a lot of concentration to a certain type of tenant or a certain geography, are you comfortable with that, and can some of this risk be mitigated by various measures? Or interest, finance costs, is the REIT hedging against some of its exposure against some of this risk as well, so that, if interest rates do trend up again, maybe it's a little bit more protected. And then lastly also, like I think we mentioned earlier in the earlier question about the gearing of REITs. For some investors, you might want to consider whether your REITs are at the appropriate gearing level for your own risk appetite as well. No different from any other asset class, there are different things to consider. For many investors, it's also probably a good idea to employ some sort of diversification, because it's difficult to second guess or predict every possible situation that can happen. So building a bit of diversification can be helpful to mitigate on some unforeseen situation as well.
So you talked about diversification. I think it's very important when we invest. Whether is it we invest in stocks, bonds, REITs.
Yep.
Diversification is a risk management process that we use.
Yes.
So how do REITs investors actually look at diversification?
Yes.
And for investors who are just starting out, how can they go about doing it?
Right. Yeah, so like you mentioned, diversification is actually a very important thing for investors to think about and consider, and no different when you invest in REITs. And maybe I will break down this question into 3 different parts on how you can get diversification. So firstly is within the REIT portfolio itself. Secondly is you could build across different REITs, and lastly is how it can provide diversification against other asset class. So for the first one, in Singapore, like we have REITs with exposure to different subsegments. Some are hospitality, some are retail, office, data centers. But we also have a category of REITs which we call diversified as REITs. And of the 40 or so actively traded REITs, around 10 REITs hold this sort of diversified exposure. It means they don't invest solely in a single subsector. They can hold assets in different asset classes. So for example, like CICT, Capitaland Integrated Commercial Trust, they hold retail, they hold some suburban retail, they hold office assets. So this can provide a bit of diversification. Another example, OUE REIT, they hold some hospitality assets. They own a couple of hotels, and they also own some of the office buildings around town as well. A different mix of assets in your portfolio can help weather a bit of the fluctuations in the macro environment, if you will. There is potential to build up a part that is more stable and a part that is more able to capture on cyclical trends. So I think diversified REITs are something for investors to consider, if you want a single portfolio that already has diversification built in across different subsectors. Having said that, there is also opportunity to build diversification yourself. You could look for different REITs in different subsectors and invest directly in each one of these REITs to get that diversification. For a lot of investors, maybe you don't have the time or the effort to go and monitor and then transact into a single REIT at different points in time. ETFs, definitely another tool to consider. We have about 5 REIT ETFs that invest in the different REITs. So for investors, if you want just a single transaction, don't have to think too much about transaction costs, and then there's already a portfolio built in and with exposure to different REITs. Having investing via an ETF is an option to consider. And I think one of the ETFs is also eligible for CPF investments. So for different investors, you can diversify yourself through ETFs or by buying different REITs. So the last one I wanted to talk about is how REITs can diversify against other asset classes as well. We do not like things that are all heavily correlated, where something goes up and then everything goes up, and then something goes down, everything goes down together. So ideally, your diversifier should be able to be less correlated with your other assets. And on this front, REITs can be a good diversifier for portfolios, because we do our correlation analysis over the past 10 years or so, and we look at how REITs perform against other asset classes. They're not strongly correlated with other asset classes such as other stocks in Asia. And then if you look at how REITs, the 2 REIT indices in Singapore, how they compare with, say, US equities or even global global equities, they have a very weak correlation or even slightly negative correlation to some of these other asset classes as well. So for investors, even for investors that are exploring different markets and different asset classes, they can consider REITs as a part of their portfolio as well to diversify. Yeah, there's different ways to think about diversification, and these are just 3 examples of how REITs you can do it within the portfolio across different REITs, and then even with other asset classes, it could be suitable as well.
Thank you, Raphael, for joining us today and sharing your valuable insight on the REIT sector in Singapore and the trend shaping investor behavior. For investors who are interested to start your REIT investing journey, you can invest your REIT at competitive rates through iFAST client login. You also can connect with me to learn more. We will see you in the next episode of Investor Insight. Bye-bye.